The country you live in right now has a national debt of $39 trillion, 722 banks holding losses larger than half their own capital, and a war costing $2 billion every single day. And the people in charge are not telling you any of this. That is not a conspiracy. It is a documented historical pattern. Same stages, same order, every single time. And the United States has now gone through 5 of those 7 stages. The 6th has already begun. Most people will not understand what that means until it is too late. You are finding out right now. A British military historian named Sir John Bagot Glubb spent his whole career studying how empires fall apart. Not one or two, but all of them. Across continents, centuries, and cultures. And he found the same 7 stages every single time. Military overextension, currency debasement, a debt spiral, the loss of productive capacity, social decay, the loss of reserve currency status, and then the fall. Same order, no exceptions. Now here is where it stops being a history lesson. The U.S. defense budget this year is $892 billion, with a proposal to raise it to $1.5 trillion. More than 750 American military bases spread across 80 countries. The dollar has lost 98% of its buying power since 1971. The national debt has crossed $39 trillion. The manufacturing share of GDP has dropped from 27% in the 1960s to just 12% today. Every major social measurement, trust, birth rates, life expectancy, mental health, is falling at the same time. That is not a coincidence. That is 5 stages. Now, before we get to the banks, the war, or the bankruptcy numbers, there is one thing that needs to be understood first, because everything else is painful but manageable as long as one condition holds. The US dollar has to remain the world's reserve currency. Reserve currency status is the most powerful structural advantage any country can have. It means the entire global economy needs your currency to do business. You borrow at rates no other country gets. When you print money to cover deficits, the inflation spreads outward to the rest of the world instead of landing on your own people. It is not just an advantage. It is the foundation underneath every other advantage. And right now, it is cracking. The dollar's share of global foreign exchange reserves has dropped from 73% in 2001 to about 54% in 2025, a loss of 19.4 percentage points in 24 years. China has cut its U.S. Treasury holdings by more than 45%, from $1.3 trillion in 2013 down to $730 billion by mid-2025. Its reserves shifted from roughly 40% dollar-based assets around 2010 to less than 1% by 2025. That is not a portfolio adjustment. That is a deliberate, structured exit. And the exits are speeding up. Central banks around the world have been buying more than 1,000 tons of gold every year since 2022. Iran is charging yuan-based tolls at the Strait of Hormuz. Indian refiners are settling Russian oil in yuan and dirhams. Saudi Arabia, the cornerstone of the petrodollar system since 1974, is now a full BRICS member, using non-dollar settlement system. 11 nations representing nearly 40% of global GDP are building payment systems specifically designed to move trade outside of SWIFT. So what does this mean for you directly? When global demand for dollars falls, demand for US government debt falls too. Washington has to offer higher interest rates to attract buyers. When rates rise, your mortgage gets more expensive. Your car loan, your credit card, the government's own interest payments all balloon, forcing more borrowing, more printing, more inflation eating away at your savings. That chain is not a forecast. It is already moving. The war pushed it forward by about a decade. Every empire that lost reserve currency status saw living standards fall sharply within a single generation. Britain went from controlling a quarter of the planet to rationing butter. within 10 years of losing the pound's global role. The question is not whether dollar dominance will fade. That is already happening. The question is whether it takes 20 years or 5. Here is a number that puts all of this into context. In 1945, the state of Pennsylvania alone produced more steel than Germany and Japan combined. One state, more industrial output than 2 of the most advanced manufacturing economies on Earth, both running factories at full capacity. That was the productive foundation of American power. Here is what it looks like today. Since 1998, the United States has shut down nearly 70,000 factories and lost 5 million manufacturing jobs. Not modernized, not merged, shut down, locked the doors, sold the equipment, and left behind what people politely call the Rust Belt, which historians will more accurately describe as the wreckage of a former superpower's industrial center. The manufacturing share of GDP has fallen from 27% in the 1960s to 12%. Between 2000 and 2010 alone, the country lost 1/3 of all remaining manufacturing jobs in a single decade. In 1980, the manufacturing trade deficit was $25 billion. By 2020, it hit $922 billion. Economists point to the service sector surplus as the offset. That surplus grew to $245 billion. It does not come close to covering a $922 billion gap. The math does not work. But here is what often gets overlooked. McKinsey found that manufacturing, just 11% of GDP, drives 20% of capital investment, 30% of productivity growth, 60% of exports, and 70% of all business research and development. Take away the factory floor, and you do not just lose jobs, you lose the engine underneath the entire economy. The U.S. share of global manufacturing dropped from 28% in 2002 to 16.6% by 2018. China's rose from 8.7% to 28.4% over the same period. They literally switched places. That dependence is now a direct strategic problem. The U.S. relies on China for 90% of rare earth processing, materials found inside every piece of advanced military technology it builds. It relies on Taiwan for the most advanced computer chips. It relies on India and China for the majority of pharmaceutical ingredients. The Congressional Research Service did not say this vulnerability might develop. It said the damage is already done. The war made that dependence visible to every ally and rival. Watching, 3/4 of the American public opposed this war before the first strike. That matters. But it is not the most important number here. The most important number is $2 billion. That is the daily cost calculated by Linda Bilmes, a war budgeting expert at Harvard Kennedy School. Not per week, not per month, per day. By the time this video ends, another $83 million will have been spent. The Pentagon told Congress the operation has cost $29 billion so far, up from $25 billion just 2 weeks earlier. Democrats on the Armed Services Committee put the real total at $40 to $50 billion once battle damage and other costs are included. Professor Bilmes calculated the full long-term cost at no less than $1 trillion, covering weapons replacement, equipment repair, permanent budget increases, decades of veterans' health care, and compound interest on all the borrowed money. George W. Bush's advisor was fired for predicting Iraq might cost $200 billion. It reached $5 trillion. The same pattern of lowballing the numbers is running right now. One figure makes the strategic problem impossible to ignore. In the first 4 days of this conflict, the U.S. fired more Patriot interceptor missiles than it had supplied to Ukraine. Over 4 full years, each Patriot costs $4 million. The drones they shot down cost less than $50,000 each. That is an 80-to-1 cost ratio. That is not a defense strategy. That is financial collapse wearing a uniform. The Pentagon is now requesting $5 trillion for fiscal year 2027, more than 40% above this year. If passed, that pushes defense spending 20% above the World War II peak. Once that baseline is set, it grows. An extra $100 billion per year becomes $1 trillion over the next decade. Every single dollar is borrowed. Before the war, the U.S. was already projecting a $1.9 trillion deficit for 2026. The national debt had crossed $39 trillion. Interest payments were already consuming 15% of the federal budget at the highest rates in 20 years. The Small Wars Journal used one word to describe the U.S. position: insolvent. Strategically insolvent, with commitments in Europe, the Pacific, and the Gulf that can no longer be supported by its drained arsenal, stretched budget, or strained alliances. At a NATO exercise in March 2026, an Italian destroyer left mid-drill to redeploy to the Iranian theater. A US F-35 squadron was absent, reassigned to the Gulf. Weapons deliveries to Baltic allies were delayed because inventory had already been used up. The empire is making promises its military cannot keep, all at once. Every country at that exercise understood exactly what they were watching. If this is giving you a clearer picture of what is actually happening, a quick like helps more people see it. One tap, that is all. And while the war is burning through borrowed money overseas, something else is happening inside the financial system that almost no one is talking about. What is about to be described here is happening right now, with almost no mainstream coverage. If the average American understood what the banking system actually looks like at this moment, lines outside branches would start forming by morning. 722 American banks have reported unrealized losses exceeding 50% of their own capital. More than 700 banks are holding paper losses larger than half the money that is supposed to back your deposits. At the same time, the Federal Reserve injected another $18.5 billion through overnight repurchase agreements, which are short-term emergency loans where the Fed buys securities from banks overnight and sells them back the next morning to keep the system running. That single injection was the fourth largest since COVID. Bigger than anything during the dot-com crash, it barely made a headline. Here is what caused it. When the Fed raised rates in 2022 and 2023, the market value of bonds those banks were holding dropped sharply. Because that is simply how bonds work. When rates rise, existing bonds lose value. Banks that bought treasuries at 1 or 2% yields found themselves holding assets now worth 30, 40, or 50% below what they paid. Those losses are called unrealized because the bonds have not been sold yet, but the losses are real. If depositors pull money out in large numbers, those banks have to sell at whatever price the market will give. That is exactly what brought down Silicon Valley Bank in March 2023. That was not a one-time event. It was a preview of a weakness that has only grown since then. The war locked that problem in. Oil above $110, reignited inflation, and took rate cuts off the table for 2026. Those underwater bonds are staying underwater. Now, layer private credit on top of that. Shadow banking funds lending to mid-sized companies outside normal oversight have grown to $1.8 trillion. Some have quietly restricted withdrawals. At least one major fund froze them entirely. When investors cannot get their money out, they start selling other assets to cover their needs. And that selling pressure ripples across the whole system. Jamie Dimon warned this year about a cockroach event. 1. Failure, triggering a chain reaction that exposes hidden problems everywhere. Michael Burry, who predicted the 2008 crash early, has pointed out that over 60% of equity fund assets now sit in passive index funds that buy without discrimination. The baby boomer generation that fed those funds for 40 years is hitting mandatory withdrawal age. By 2028, required withdrawals will exceed new contributions for the first time ever. The engine that inflated markets for 3 decades is about to go into reverse. Major tech company share buybacks dropped 74% in the fourth quarter of 2025, from $48 billion to $12.6 billion, as money was redirected toward AI infrastructure. The floor under market valuations is disappearing at exactly the wrong moment. This is what the late financial stage of imperial decline looks like. Not one dramatic crash, but a slow, connected wearing down of confidence across institutions, hiding their fragility behind accounting labels. 722 banks are already there, and it is not just the banks. The pressure is already visible in the everyday economy too. 565,000 Americans filed for bankruptcy in 2025, 11% more than the year before. 2026 is moving even faster. Individual filings in February came in 13% above the prior year. Business bankruptcies are up 21%. Now here is the number that stopped analysts cold. Small business bankruptcies, the corner bakeries, local contractors, family manufacturers, neighborhood, service businesses are up 91% in a single year, nearly double in 12 months. That is not an economy gently slowing down. That is the foundation crumbling under the very people who build, hire, and serve in communities all across the country. The consumer credit data tells you exactly how it got here. 111 million Americans are carrying a credit card balance right now, 40% of all adults. More than 27 million can only afford the minimum payment. A growing share are maxing out cards, opening new ones, or turning to payday lenders just to cover basic living expenses. Average rates are around 23%. At that rate, minimum payments do not reduce the balance. They pay the lender while the original amount grows every single month. That is not treading water. That is treading water while the current underneath keeps pulling harder. The delinquency data confirms the breaking point has been reached. The New York Fed reports that 8% of all outstanding household debt is now past due. Subprime auto delinquencies hit 6.65%, the highest on record since tracking began in the early 1990s, higher than 2008. Car loans are historically the last payment people skip, because losing the car usually means losing the job. When auto delinquency breaks records, it means credit cards, medical bills, and utilities have already gone unpaid. The car was the last thing standing, and now that is going too. Here is the piece that changes the whole picture. All of these numbers reflect pressure that existed before the oil shock, before inflation reignited, before rate expectations flipped. Second and third quarter data will capture the full effects of the war. Every historical comparison says the decline steepens from here, not levels off. And when shadow lending markets freeze withdrawals and cut off credit, the mid-sized companies that depend on that funding lose access overnight. They cannot make payroll, cannot restock, cannot service their own debt. That surge in small business filings is the early signal of a contraction that has not yet fully hit Main Street. When it does, it will not arrive slowly. Now connect that to something most people have not yet linked together, because the economic hole being dug is about to get a new shovel. A senior executive at one of the world's largest tech companies told his own leadership team last month that most of them would be replaced by AI within 3 to 5 years, not warehouse workers, not customer service staff. The executive layer of a trillion-dollar company was told by their peers that the technology they are building will make their own roles unnecessary within a presidential term. This is not a forecast. It is already happening. A major U.S. retailer cut 16,000 corporate jobs in one announcement. Not floor workers, but corporate, technical, and administrative roles. A software quality assurance manager with 30 years of experience described how AI had taken over his entire workflow. He no longer writes test cases or produces code. He types instructions into a system that does all of it. He still has the job, but he is telling you it no longer requires a human to perform it. A physician at a major academic medical center was let go alongside colleagues, despite the department carrying a 3-month backlog. The need was real. The jobs were cut anyway. The progression matters. Stage 1 is generative AI. It responds to instructions. Stage 2 is agentic AI. It carries out the full task sequence a human employee used to handle. That is the stage currently running inside the economy. Stage 3 is artificial general intelligence. Stage 4 is superintelligence. The gap between where things are now and where this ends is closing faster than any policy system can keep up with. Here is the connection almost no one is making. The previous stage of American decline was the loss of manufacturing to outsourcing. The service economy absorbed that loss, becoming 80% of US GDP. The engine of the middle class for 40 years. If AI hollows out the service economy the way outsourcing hollowed out manufacturing, there is no third economy waiting to take its place. Finance, legal services, healthcare, software, logistics, accounting, marketing, human resources. Every sector is inside the danger zone. The outcome is a wealth gap wide enough that only 2 groups functionally remain: people who own the systems and everyone else. The government meant to manage this shift is currently proposing to spend $1.5 trillion on the military, while cutting food assistance for low-income families. That is not how you prepare for a major change. That is how an empire spends its last resources before the lights go out. On top of all of that, there is one more threat that is less visible, but just as serious, and it is one the Federal Reserve has almost no good answer for. Moody's recession model sits at 49% probability for 2026. Goldman Sachs is at 30%. Pantheon is at 40%. HSBC is at 35%. Prediction markets have jumped from 20 to 38% since the war started. But what economists are actually worried about is not a recession. It is stagflation. If that word is not in your vocabulary, it needs to be, because it may define your financial life for the next 2 to 3 years. Stagflation is when inflation stays high while the economy slows and unemployment rises at the same time. In a normal downturn, the Fed cuts rates, borrowing gets cheaper, businesses invest, consumers spend, and the economy recovers. That framework has worked for 80 years. Stagflation breaks it. Cut rates and inflation gets worse. Raise rates and the economy contracts harder. There is no clean move available. That is exactly where the Fed is right now. The Fed held rates steady at 3.5 to 3.75% in March because every direction was damaging. Cut, and you pour fuel on inflation already running hot from the oil shock. Raise, and you push an economy already losing 92,000 jobs a month toward full contraction. The CME FedWatch tool now shows greater than 50% probability of a rate hike, not a cut. A stunning reversal from just weeks ago. The OECD revised its US inflation forecast up to 4.2%, driven almost entirely by energy costs. Deutsche Bank and Oxford Economics modeled Brent crude at $140 for 8 weeks. Mild contraction across developed economies. The US trending toward a standstill and unemployment rising. Every $10 oil increase removes 0.2 to 0.3% from GDP, while adding 0.4% to inflation. Oil moved from $70 to $110 in 3 weeks. That math is already inside the system. The last time this happened was the 1970s. The OPEC embargo choked oil supply, sent inflation to 12%, and slowed the economy all at once. Paul Volcker broke it by raising rates to 20%, deliberately triggering one of the worst recessions in modern American history. The current supply disruption, with Gulf production down by at least 10 million barrels per Dalton Y, is being called the largest oil supply shock in the history of the global market. The trigger is the same: and the last time it was applied, the cure required crashing the economy on purpose. Whether today's leadership has the discipline to do what Volcker did is the open question. If it does not, the inflation does not break. It compounds, and the slow erosion of your buying power becomes a permanent condition. Now, step back for a moment, because when you put all of this together, it starts to look like something familiar. Rome did not decide overnight to destroy its currency. They shaved small fractions of silver from the denarius, one minting at a time for centuries. To fund wars the tax base could not cover. Officials told the public the currency was sound. The empire was strong, and the setbacks were temporary. The Roman public believed them until the coins stopped buying bread, and the armies could not be paid. Spain believed its wealth was permanent because it seemed endless. Half the world's gold, and silver, military dominance, a currency accepted everywhere. Within 80 years, 4 bankruptcies, and irrelevance as a world power. The flood of silver had removed every reason to build productive capacity. When it ran out, there was nothing left underneath. Britain controlled 1/4 of the earth. The pound was the global reserve currency. The phrase, "the sun never sets on the British Empire," was a literal geographic fact. Within 40 years of entering the First World War, it was over. Reserve status lost at Bretton Woods. The top 1%, holding more than 70% of national wealth. The military stretched too thin, and food rationing still in effect a full decade after World War II ended. The richest empire in history, rationing butter and bread. The Soviet Union spent 15 to 20% of GDP on the military, stagnated economically, ran a currency nobody trusted internationally. And when oil prices collapsed in the 1980s, the entire structure dissolved in 900 days. Not 900 years, 900 days. Now look at the United States in 2026. Defense spending at $892 billion with a proposal to hit $1.5 trillion. 750 military bases across 80 countries. The dollar down 98% in buying power since 1971. $39 trillion in national debt, interest payments consuming 15% of the entire federal budget and climbing toward $1 trillion per year. 70,000 factories closed, 5 million manufacturing jobs gone. The dollar's reserve share fallen from 73% to 54%. China's Treasury holdings cut by 45%. Foreign ownership of U.S. debt dropped from above 50% to 30%. BRICS nations, representing 40% of global GDP building systems, to replace the dollar. 722 banks holding losses exceeding half their capital. Small business bankruptcies up 91% in a year. 111 million Americans carrying credit card debt every month. 53% unable to cover a $100 emergency. Most working Americans with less than $1,000 saved for retirement. And a war Harvard projects will cost $1 trillion, borrowed at the highest rates in 20 years, on top of the largest debt load in history. Every warning sign that came before the collapse of Rome, Spain, Britain, and the Soviet Union is measurable in the United States today. All of them. The pattern has held for 500 years. Every civilization that followed it believed they were the exception. Not one of them was right. And here is the part that is the hardest to hear, because it changes how you see everything else. The American empire is not being brought down by China, not by Iran, not by BRICS or Russia or any outside enemy. It is being taken apart by choices made inside American institutions over 50 years, by people and systems that rewarded exactly those choices at the time. The 70,000 factory closures were not forced by a foreign power. They were decisions made by American executives to improve quarterly returns by moving production to cheaper labor markets. The Saskin $39 trillion debt was not built by an invader. It was accumulated by American legislators in both parties who consistently spent more than the country collected. Because restraint loses elections and cuts lose donors, the debasement of the dollar was not an outside attack. It was a deliberate domestic choice when Nixon ended dollar convertibility to gold in 1971. And every administration since has used money creation to cover problems too politically costly to fix. The 750 military bases across 80 countries were not an accident. They were the product of a strategy that valued global power over investing in the domestic schools, infrastructure, and productive capacity that actually build lasting national strength. The healthcare system that financially ruins families, including families with insurance, was not designed by a foreign adversary. It was built by domestic insurers, pharmaceutical companies, and hospital systems that spent billions lobbying to keep it exactly as profitable as it is. The housing crisis was the result of policy that repeatedly protected existing asset values at the expense of everyone trying to get in. The student debt crisis was built by universities that raised tuition at 4 times the inflation rate for 40 years, backed by lenders who gave out money freely because that debt was nearly impossible to walk away from. And the wealth gap was engineered by a tax code rewritten decade by decade, taxing labor at higher rates than capital, applying the capital gains rate at roughly half the rate of wages, and letting the wealthiest pay a lower effective rate than their own employees. And the war accelerating all of these trends was not a defensive response. 75% of Americans opposed it before it started. It was a decision made by people in power, funded with borrowed money that children in elementary school today will spend their working lives paying back. This is the hardest thing to sit with because it removes the comfort of blaming an outside villain. Every decision that created this situation was made here by people inside these institutions, each choice looking reasonable on its own. Together, they followed the exact same sequence every collapsed empire in history has followed. Military overextension, currency debasement, debt spiral, loss of productive capacity, social decay, reserve currency erosion, collapse. The US is at stage 5, entering stage 6. The only thing still undecided is whether the people living inside this system right now choose to understand it clearly enough to change direction. Yale historian Paul Kennedy predicted exactly this in 1987. Once military spending starts spiraling, and it always does because each new generation of weapons costs more than the last, there is less left for everything that actually keeps a civilization running. The empires he studied believed it could never happen to them. Not one of them was right. The empires that collapsed did not fall because their people were incapable. They fell because enough people were comfortable enough to look away from the warning signs until those signs became the new reality. The warning signs are not on the horizon. They are already here. The pattern is already running. So here is the question worth sitting with. Which of these stages do you think is the most dangerous and why? Drop your answer below. Every comment gets read.